On today's show, 3 questions. Number 1, what's driving our economy? Number 2, how much can you contribute to your 401k in 2025? And number 3, what's the cost of the American dream? Welcome to Dentist Monday's 2 Cents, where we have dentists navigate all the noise. I'm Matt.
I'm Jake.
And I'm Rabih.
Yeah, you are. Rabih, we have a guest again. We have our guy, Jake. The trio's back together.
Love to be here. It's great.
We went 2 weeks in a row with just Rabih and I. We were feeling quite lonely.
Okay.
Yeah, because we couldn't get anyone else because it's, busy time of year. We get it. So Rabih and I went on. We yapped. We still somehow filled 45 minutes, but it's good to have you on, Jake, and have the trio, the gang back together. So
it's awesome.
Happy belated Halloween, everyone. Hopefully everyone, by the time you're listening to this, has recovered. We were just saying my kids had about a stamina of 45 minutes and they were done. Jake, your kids lasted
2 hours-ish. Yeah, about 2 hours. I was impressed. Yeah.
Rabih, how long did you trick or treat for?
None. Great.
Well, let's jump in. Rabih, as always, let's hit what's driving our economy, what's going on with the markets.
Yes, we've got some good economic data, and we got data about everything. We got unemployment, we got inflation. Inflation is in line with expectations, so no news is good news. Unemployment is still at 4.1%. Also, no news is good news. The only thing that was off that showed was the jobs creation, non-farm job creation. And for the month of October, it was only 12,000 new created jobs versus like 120-ish on average, 120,000 jobs on average are being created every month in the US. October was only 12,000. But the market didn't fret it. They know it's an outlier, and the reason for it is the hurricane that hit the east coast of the US, as well as the Boeing strike. So those have created a blip in the data, but regardless, the market is up big today, and the economy is in its equilibrium, and we're enjoying it, type of thing.
Well, Rabih, you mentioned the Boeing strike. You know how we end strikes in America nowadays, right? We just talk about it on 2 Cents.
Oh yeah, true.
This
so
is
it's going to be over tomorrow, I guess.
Jake,
when
did you
this
hear about this?
Released.
We a couple of probably 3 or 4 weeks ago, we were talking about the port strikes. That was Will's topic, and we recorded a little bit earlier in the week that week. So it's Thursday. We were talking about the port strikes, and then we were like, "Oh, hopefully they can figure this out, whatever." And then that same day we recorded, and that same day I got a blip on my phone that was like, "Port strikes end." So I texted Rabih and Will. And I was like, "Well, we ended the strikes," and then the show came out on Saturday, so it was like it was already over by the time it actually got released.
Yeah. So moral of the story: if there's a strike, send it our way.
Just send it our way. We'll talk about it.
We'll move markets too. We're like, hey, the market's great, everything's going fine. Then something will come out and it dips, and 2
cents, just moving markets and changing the economy. Yeah. Love it.
True. Okay. The meatiest part of the whole data that came out was GDP related, and that is cool stuff. So just to give you some background, remember in the summary of economic projections, the Federal Reserve said that they want the economy to be growing at 2% on average for the whole year, right? And then we got Q1, which was low. I'm only going to talk in annualized term, just not to confuse you guys, but the actual number is divided by 4. But in annualized term, instead of a 2% growth in Q1, it only came in at 1.6. And then in Q2, it came at 3. And if you average them, we're back to 2. And the market expectation was that in Q3, and this is the first estimate, also a reminder, we get 3 estimates. The forecast for the Q3 estimate was that the economy is going to be growing at another 3% for Q3. And the data came in below expectations, but regardless, it came in at the growth of 2.8%. So now we've got 1.6% in Q1, 3% in Q2, 2.8% in Q3. And if you average these 3 quarters out, the growth year to date of real GDP of the US economy is 2.5%, which is 0.5% above the 2% target. So this means if the Fed is going to be right and we're going to end the year at 2% real GDP growth, Q4 GDP levels could be as low as 0.6%, and we'd still end the year at 2% growth. So there's a really good chance we're ending the year above a 2% GDP growth, given the trend in the data. And this just means that we're beating our own expectations or the Fed's own placed expectations on what the Fed of the real GDP is going to be growing at. And that is the healthiest data point financial assets can get, especially stocks. And we are seeing it reflected in year-to-date returns. I wanted to break down where that 2.8% is coming from, and just to tell you who really runs the economy. So 2.8%, 2.46% of this 2.8 is coming from consumer spending. You've got 0.07.
You cannot stop Americans from buying crap.
No,
which is great. 2.46% is 0.07% is coming from like investments. 0.85% is coming from government. And if you add these up all together, those three, they are above 2.8. But because we import more than we export, you subtract out 0.56 and we get to the 2.8. So economy 95%, 97% is run by consumers. There's a little bit of government spending that is stimulating the economy. Investments is a portion of the GDP. And what's interesting about investment is that it is a leading indicator. And because the economy has been slowing down and now is dealing with higher interest rates, investment spending and depletion of inventory is what's been happening. And as you see, contribution from corporate investment into the GDP is low. So this just tells you that yes, the economy is healthy, it's growing at a strong pace, but forecast is that it's slowing down, and that's because we raised interest rates quite a bit. So as we look at this data every quarter as it comes, when investment starts flipping and starts going up, it means that now the economy is in acceleration mode once again.
Rabih, really quick, when you say investments, are you referring to, what are they factoring in investments? Are they talking about like capital investments by companies, or are they
100%.
talking? Okay, got it.
This is what it is. It's usually investment in R&D, capital expenditure, machinery, anything that they are placing as, it's a purchase for investment purposes.
Got it. You said 0.7% of
0.07.
Oh, 0.07.
So
okay,
it's kind of zero if you
got
think
it.
about it.
It's a rounding error.
Yeah.
But Amazon purchases, not a rounding error.
Yeah.
So crazy.
Sure. And I think this is healthy. This is good. Because this is what's the contribution of each to the 2.8%, but also every single component in the US economy has like a multiplier to it. So every dollar spent by the consumers grows the economy by probably more than $1. But every dollar spent by investment companies in investment form, it grows it even by more than consumers. And like governments, every dollar spent by a government is usually below $1 impact on the economy. So each bucket in this economy is more efficient than the other. And the most efficient spender that grows the economy the most is the consumer. And that's why if you compare it to other countries around the world where they are heavily focused on the government driving the economy, or on the business sector to drive the economy, or on export to drive the economy, just like in China, you do not see every dollar spent by these components contributing to the GDP at the same rate. Consumers, we call it the marginal propensity to consume. There's a coefficient that is multiplied by every dollar spent to the consumer, and it is the highest. When a consumer spends, it impacts GDP the most.
You're saying this, okay, just to make sure I understand, the dollars spent by citizens has a bigger impact than like spending by the government.
Yes.
Like the efficiency of the spend 100%. And its direct impact. Is that just because, I mean, maybe this sounds cynical, but the layers of spending the government goes through, like that dollar as it goes through all its layers, that doesn't actually hit the economy, whereas like it's more direct by the consumer?
That one. Two is that the fact when consumers are spending, they are spending within the same economic cycle. It's producers, consumers, producers, and
it's more of a lag with the government.
Yeah, whereas a lag, it's you're taking it out of the system. And like import and export are actually removing from the system, adding to the system, where consumers is like doing laps in the system.
Got it.
So it is more. And yeah, I think, if I'm not mistaken, hopefully no one corrects me on this, but every dollar spent by consumers increases the GDP by like $1.10, but every dollar spent by a government increases the economy by like 0.8.
Got it.
Dollars. Yeah.
Okay. Awesome, Rabih. Jake, you've yawned a few times. I just want to make sure you're awake. You're feeling okay. Rabih.
No, yeah, that's
Number heavy,
fantastic.
huh?
We've talked about this a million times on this podcast, which is that consumer spending is just so strong. I'm just at the point now where I don't know what slows it down. I mean, we saw crazy inflation over the past couple of years. People are incessantly whining about the price of everything, yet we are just still buying at those higher prices. If really high inflation isn't going to slow it down, what will? Right? I mean, at this point, is it just a runaway train? My guess is there will be something in the future that probably slows down consumer spending. Lost jobs or something like that will probably be a catalyst for that. But it's wild, man. We just love to buy. I'm assuming the next couple of months too, with the holidays coming, that is not going to change.
I was just going to say, we're going into the holiday season.
Yeah,
it's more of fertile ground for more spending. And what Jake was mentioning is like what slows this down. And usually it's consumer confidence. We got consumer confidence data on Tuesday, October 29th. And the previous reading for consumer sentiment. And again, if it's above 100, it means that the confidence is really high. And if it's below 100, it means that people are afraid, they are cutting back on spending. And this might have an impact on retail sales. Last reading was 99.2. The expectations, the median forecast for this month was about 99.5, but the actual data that came in was 108.7. So consumer confidence is high, and it is higher than what we expected. And coming into holiday season, we just had Halloween, we got Thanksgiving, Christmas, just expect more spending and probably better economic data, which financial assets tend to reflect.
So, Rabih, not to go too far down a rabbit hole here, but all of this kind of is leading me to think, and some of the rumblings I've heard and read about and heard on another podcast is maybe some concern that the Fed cut rates too aggressively and that inflation actually isn't gone or is going to come back based, I guess I just want to get your thoughts, like, for us to just sit here and pretend like inflation can't just pick right back up again, I think is probably a bit naive. Like, where are you at with that?
It can pick up back again. And here's why we fall into the error of like, we put it all on the Fed. The Fed is one moving part out of a global economy. And this is the economic assumption, ceteris paribus, assuming nothing else changes in the economy. The Fed right now maybe was late in July, but maybe was too aggressive with a 0.5. We don't not know, but the economy based on the last couple of readings is in an equilibrium. So now make the Fed as the constant and change other stuff, change geopolitical risk and probably a strike on oil reserves that might bring oil prices higher. That is inflationary.
We'll fix that.
That's inflationary to the US. Or put in climate risk that might disrupt free transportation and like transport of goods and services into the US. That would be inflationary. Put in other supply chain issues, including strikes in companies. That is a domestic problem, but that is inflationary to the economy. So you've got external forces that might be inflationary, that might show up in the next week or so, or in the next year. But you're also got deflationary forces that might show up in the next year or so. The possibility of economic slowdown in China, right? Because they've been trying to stimulate their economy. Europe is a big spender, is the second, third largest spenders in the US, in the world, next to the US. So the idea that they might be cutting down, their economies are slowing down, that would have an effect overall. So the idea is there are hypotheses. Some people are saying, oh, inflation could pick up, and they are true, but it won't pick up just because of what the Fed did. It's going to pick up because of what the Fed is doing, along with external factors that could sway in either direction. Those are the risks that we live in day to day. Could inflation come back? 100%. Could a recession come back or show up? 100%. It's more of how do we navigate this whole thing to stay at an equilibrium state in the economy. This is the golden.
Rabih, I mean, how dare you talk with logic and nuance? Just don't. How dare you?
I love that point though, right? Inflation isn't just all on the Fed. Is like that is, I think some people may think that it is this huge economic force that happens and no one person or one entity controls it, right? So like they're trying their best to do what they can, but yeah, man, I'm worried. I would raise my hand of like, I think, if we're cutting rates too soon or too aggressively, that inflation could come back. I would raise my hand as be someone who's about that.
I think that's the point too, Jake. I'm with you and Rabih. Everything you just highlighted, but we've talked about this so much about the Fed and them doing the best possible job they can do with the factors that they have and the knowledge that they have. And I think it's why I make jokes about you using any level of nuance, Rabih, because most people don't do that. They just want headlines. But
Yeah.
But with that said, I think I guess the worry just being, Rabih, the main worry being, you just went through all the details, but of just saying like, are we really like, there's this feeling of like, okay, we're beyond inflation. Like, okay, we've conquered it. We're moving on. And I'm like, I'm not totally sure.
Or do we even need lower rates either? That's what I also wonder. Like, why do we need to be aggressively cutting these? I don't know.
Yeah.
The talk about inflation, actually what's causing worry about inflation isn't inflation numbers per se. If you look at the trend of inflation numbers, it's just been going down and plateauing a bit. It never changed direction on the upside. So inflation isn't what's causing us to worry about inflation. It's unemployment that's causing us to worry about inflation, because taking you back to June and July, unemployment went from 3.7 to 4.1 all the way to 4.3 at some point, right? And then suddenly in August started going back down from 4.3 to 4.2, and now we are at 4.1. Back when it was 4.3, we were saying, oh, the Fed is too late. Europe already cut rates in July. Why is the Fed waiting till September? And that more of like talk on the street is what prompted the Federal Reserve to cut 50 basis points. But given that unemployment switched and went back to 4.1, we're saying, oh, were we wrong? Like we are doubting ourselves. So given that unemployment is what's scaring us about inflation, I honestly, you should only look at inflation data when you're worrying about inflation. And you look only at unemployment when you're worrying about economic slowdown. Low unemployment does not mean inflation. And we experienced that through the whole decade, kind of from 2015 to 2019. At the peak of it, we
record
had
low inflation.
Spectacularly low unemployment and inflation. So let's not mix those two metrics.
Yeah. So last thing on this, Rabih, I guess if we're just on this topic of the Fed and the rates and all that, they have another opportunity next week.
Yes.
The day after the election, right?
Yeah. Next week, we're going to get a new president and a new interest rate level. So we'll go from there. And this is why we're seeing the volatility. The moves, while the market's kind of still flat over the week, the moves have been of a larger magnitude on the upside and the downside. And this is the volatility we talked about. We expect right before elections volatility to be there, although the market has went nowhere. So yeah, we'll see. Just stay in your seat.
Yeah. I mean, and next week we will have a new president. We don't know who, but we will.
Yeah.
Now this is the opportunity for us to go around and say who we're voting for and why. Go ahead, Rod. No, I'm just kidding. So we're not going to play that game. Rabih, anything else? Yeah, go ahead.
Political presidential election question. This is off the path.
Please get really political. Yes.
What would you guys be more surprised by? Because I know everyone's always worried about, okay, what is a new president or how does the election impact my portfolio or my money? Would you, with the state of the economy, Rabih, would you be more surprised that that the market just remains flat after the election, or that we get movement up or down? What would be more surprising to you?
Good question.
And we're going to hold you to this, by the way.
Okay. Okay, then let me think of it. Would I be surprised?
Because it's just right now, it is just a freight train again. It seems. I mean, the S&P 500, the U.S. market,
actually,
everything is just moving.
I would be surprised if it crashes down, because both candidates are not coming up with. If you listen to the political debate these days, it's not really. It's more social aspects. They're not fighting on. We've had times where the campaigns were about the economy. I'm thinking, Obama, McCain, right? Like it was much bigger focus on the economy. Right now, we have other talking points that each candidate is using that are not focused on the economy. And when politicians are not meddling to the economy, the market loves it. It's just like, just let capitalism do its work, let it run. So I would be surprised if we see it going down. I think both candidates are not focusing as much on the economy as in previous presidential elections, and this should leave it going sideways or going up depending on earnings, which brings us to earnings. This is the last point, Matt.
Look at that segue. Look at that segue. Professional.
And this earning season in the S&P 500, so far around 260 companies have reported earnings. 44.7% reported earnings above analyst expectations, which also compares to be above the long-term average of 66.9%. Also, like the earnings are around the growth year to year is around 6%, and if you exclude the energy sector, it's about 8.7%. And revenue growth is 4.5%, excluding the energy sector year to year. It's 5.5. So it is a very good earning season, like the previous, I'd say, 5 quarters of earnings that we've had. So the market cares more about this than who is going to be elected, especially that they won't be in office till January. So yeah, I would be surprised if it goes down. Like, we'll have an
Rabih, sorry, what percentage of companies did you say are coming in above?
So 260 reported. I don't have what percentage above and below. I can get it next week. But,
okay.
Of the 500 companies in the S&P, 260 already reported.
Okay.
And, on average, 77% are above.
77%. Okay.
Not companies. 77% of earning numbers are above analysis.
Got it. That makes sense.
Yeah.
Above the average, which is, you said 60-ish%. Okay, cool. Things just keep rolling. Things just keep chugging. So that's awesome. Okay. Thanks for that, Rabih. Let's jump into how much can you contribute to your 401k for 2025? Guys, I think we all know we're wrapping up the year 2024, which is wild. For 2024, you can contribute your max contribution to a 401k is $23,000. The IRS thought, you know what? Let's take into account inflation and let's adjust upwards for that. They do this from year to year. Sometimes they adjust it, sometimes they don't. Guys, you want to know what they came in at? You want to know what their adjustment was? So $23,000 for 2024. They thought they would be benevolent and add $500. So for 2025, it is $23,500.
Okay, here's the deal. I know there are IRS officials, really high up officials listening to this podcast, and I know they're
of course. We're going to change this now. We end strikes and we make IRS policy changes.
So my petition. I think every IRA, 401k, any retirement account contribution limits need to be divisible by 12, like on an even number. This is my petition. Why couldn't we go to 24,000, make it an easy 2,000 a month you could do? Same with IRA. Like, I just want everything divisible to an even number by 12. That's my petition. That would just make everything so much easier and nicer.
I'm with you. Totally agree.
23,500. That's annoying.
I'll make some calls.
Can I defend them? I think 500 is a no.
I'm just kidding.
I think 500 is decent. I just took the ratio and it's a 2.17% increase, which is, inflation was a little bit above that, but that is an increase that you would put in line with long-term inflation expectations.
Okay, so Rabih, if you keep bringing logic, man, we're kicking you off the show.
I'm mad, Rabih. I don't want to put $1,950 in my 401k every month. I want to put in $2,000 even. That's what I'm complaining about here.
Yep.
Okay.
Yep. Rabih, you need to stop. Okay. It's
not about their spreadsheets looking good. It's about our, drafts.
Yes. Rabih, here's my thing. I'm still hungover from sugar from Halloween, and you're coming in with all this logic. I don't like it. Okay. So they just announced this for 401ks. They also announced IRAs, no change. So, Rabih, what do you have to say about that? No inflation adjustment for IRAs.
Oh, yeah. Okay.
They did change catch-up contributions for 401ks. So if you're over the age of 50, as a reminder for everyone, if you the year you reach 50 or older, you can do what's called a catch-up contribution. The IRS also said they adjusted that. Where is it? They went to $7,500. Oh, it'll remain. So that's what it was for 2024. They're keeping that the same. No adjustments for IRAs. The other thing we wanted to talk about as an opportunity would be they made some adjustments to some tax brackets to adjust for inflation as well. So a couple of changes, and this is for 2024. They actually have adjusted this as you go to file your taxes. They made some adjustments. And so I've got like 5 tabs open here. So I'm just bouncing between them. A couple of things they did. So number one, they adjusted the standard deduction for 2024. And I actually don't know, Jake, do you know, had they already announced this? They made it sound like this was a new announcement, but I think they'd already established this earlier in the year, maybe last year, but
I feel like I've known about a raise for a while, but I'm not sure.
Yeah, I don't know. This article made it sound like they had just announced this, but either way, it's a good reminder going into like end of the year. So standard deduction for 2024 for married filing jointly, 29,200. Pretty sizable deduction. This is why like 90% of Americans now just take the standard deduction. And then for a single filer, it's up to 14,600. So they made some adjustments there, and then made some tweaks to the actual tax bracket. The big one I think we wanted to hit that we were talking about before, which is super interesting, is they made some adjustments to capital gains rates. And so as a reminder for people how capital gains tax works. So capital gains taxes are based on capital investment. So think of your stocks, even your practice, like your private businesses, your real estate, but it's also based on your income, right? So your bracket for capital gains is based on how much income you're bringing in. And there's brackets for this that are different than ordinary income tax brackets. And so the adjustments that they made, I'll just kind of break this down. There's 3 brackets. So capital gains are really simple. There's a 0% tax bracket, there's a 15% tax bracket, and then there's a 20% tax bracket. And it's all based on your income. And so here's the brackets for 2025. For a single filer, if your income is between $0 and up to $48,350, you have a capital gains rate of 0%. So what does that mean? If you own a stock, you've got $50,000 in gains in that stock, you go to sell it, and you're below that 48,000, you pay no tax on that as a single filer. If you're married filing jointly, that's up to 96,700. So you can make almost $100,000 in America and pay no tax on your capital gains if you're at that level. And then the next bracket, which is pretty huge. So single filer from 48,000 up to 533,000 in income as a single filer, you only pay 15% on your capital gains. Anything above 533 in income, you're paying 20%. For married filing jointly, that goes up to 600,000. So as a married couple, you can make up to 600 grand and only pay 15 grand in capital gains. Anything above that goes to 20. I'm going to stop there for a second, get your guys. I know it's a lot of numbers, but any thoughts on this?
This is a big deal that I don't know if a lot of people think about this. Like, a lot of this comes into play when you're doing retirement type of planning, right? So let's say you've been putting money into just a regular brokerage account, right? This is just a regular investment account. There's no special tax incentives or anything up front. You put money in, it's really flexible. Whatever gain you have on that account, like Matt said, when you take it out in retirement, you'll have to pay capital gains tax on whatever the gain is. However, I would assume that there are quite a few people out there like, hey, in retirement, I can live off $90,000 or less as a couple. Like, that feels like a pretty, like, my spending is under that amount. I can go do the things I want. If you have a brokerage account, if you're taking out less than $90,000 worth of gains over the course of a year, you don't have to pay any tax on that money. Your tax rate is 0 if you're under that $90,000 or $98,000 limit. So that's pretty, I just don't know if people think about that often, where we always talk about 401ks or Roth IRAs having these really cool special tax advantages. If you're kind of on this lower income limits there with your brokerage account, that can also be a really awesome tax benefit. I mean, that is essentially turns your brokerage account into a Roth IRA, essentially, if you can live under those income thresholds and capital gains thresholds. So pretty cool. I'm always been an advocate that brokerage accounts are way cooler than people think they are. Anyway, that's my thought right off the top of my head.
Yeah, no, I totally agree. Rabih, any other thoughts on that?
Yeah, I really like the idea, because we say, oh, maybe 90K isn't enough for a couple filing jointly to live off, but we just have to remember that this is only the spending portion. Mm-hmm. So most often, couples who are spending 90K a year are getting much more. in income and saving and paying taxes on a good portion of it. So we're just thinking 90K of spending a year. That is really generous. And yeah, just if you want to go live outside the US and not pay taxes, it's a really sweet deal. Something that I want to clarify, just because I'm not sure of it. So you said if you are making below 90 in ordinary income, you do not pay cap gains on, you do not pay any cap gains tax on your investments, right? So does this include, so what will include towards that 90K? It's going to include Social Security, it's going to include IRA withdrawals, but it will not include anything out of your brokerage account?
It includes all of it, so they add it all up together, right? So, like, let's say you're getting
the stuff from the
if you're getting 30,000 in Social Security, and then you're taking 30,000 from your IRA accounts, then you take another 30 or another 40,000 from your brokerage accounts. That all adds up to about, you know, like $100,000. So it's additive. It all kind of adds on top and puts you in whatever bracket that is.
So the actual sale or the actual transaction in your brokerage account would lead to possibly like adding to that number, which would impact your actual capital gains. You have to factor that in.
You would need to liquidate under 90,000 essentially. Right? That's the thing. Like, you would liquidate under $90,000 worth of this investments to be able to hit that threshold.
Extreme, if you're not receiving Social Security, you are not getting money out of your IRA. All you have is your brokerage account. You can take up to 90K out of your brokerage account, regardless of how much gain you have on the positions, and you'll still not pay taxes.
Correct.
Nice.
Correct.
So it depends on what your other income is. Again, some people are going to be above that limit and whatnot, but yeah, there's a lot more flexibility there than I think people think about often. So
yeah, one other point that I think is interesting here that we don't have to go too deep into, but I just think it's worth bringing up is this is why I get frustrated when people try to simplify things like X person, like let's say like Warren Buffett only paid an effective rate of X% or whatever. And it's just a misunderstanding of the tax code and the fact that a lot of these really wealthy people, like they are the number you're quoting, the percentage you're quoting is the fact that they're so capital asset heavy. Warren Buffett does not make a W-2 income. He's not making money and paying tax on some $1 million of income is ordinary income tax rates. Warren Buffett's entire income and entire net worth is based on capital assets. So that's why I'm always telling people, like, if that gets brought up, I'm like, listen, this is not the same thing. And I think it's really disingenuous for like media outlets to be like, this person only paid this percentage in income or in taxes. It's like, okay, this is not like some high paying dentist paying taxes at ordinary levels versus Warren Buffett at capital gains rates.
Yes, he is not employing some sophisticated tax strategy that you don't know about that's helping you down. Yeah, this is a lot of people, even like Elon Musk types they're just getting income from selling their stock essentially every single year, right? And so when they're selling, even if they are selling $1 million worth of stock to support their lifestyle, the highest capital gains rate is 20%. So they're only paying 20% on all that money and not the top 37% ordinary income.
Exactly.
That's what people get mad about. It's like, they're not paying 37%, they're only paying 20%. It's just because of how they're making their income, like you said.
Rabih's thoughts. Rabih's.
No, it's worse than that. They are taking loans against their assets and doing tax deductions. It's even worse.
Yeah. So again, we don't need to go down that road. More just, I wanted to just highlight that when you're seeing things in the media, just think about it's a different situation, right? Than it's just simple like, oh, they're not paying as much taxes. It's more complicated than that. Okay, Jake, final topic. What's the cost of the American dream?
Yeah, so this website is called Visual Capitalist. They are the one who produced this data. I think the data is from Investopedia, but they have this cool graphic. I know you can't see anything on a podcast, but they broke the dollar amount cost of each of these aspects of what we call the American dream over your lifetime, right? So they have things like buying a home, raising 2 children, cost of retirement, getting married, owning cars, et cetera, having pets, taking vacations. Okay, and I just wanted to go through some of these numbers that they have here, and I want to see just what you two think about these. If you think it's right, if it's not, then we can get to like the overall cost. Okay, so I just want to break down some of these things. They said owning a car over the course of your life costs on average about $811,000 to own cars throughout your life.
Whoa.
Really?
Age 29 to 74. Does that feel right? Okay? So you guys said that feels high.
No, I mean I think it's probably right. It's such a long period of time.
Okay.
If you're factoring in like interest on loans, you're factoring in maintenance costs, you're factoring in the transaction itself.
They are excluding fuel and repairs on this, was what it says. So it's just like owning.
Are they assuming that you're buying a brand new car every 5 years?
I don't know, Rabih. I don't know. But that's what they said. Okay, 8-11.
High.
How about this? Raising 2 children. What would you think the cost of? So raising them to age 18.
$500,000.
300,000.
832,000 for two. So 400
for two.
Yep,
Okay.
400 each. $832,000 is what you have to do to raise 2 children up to age 18. Is what the costs are here.
Robbie's like, not me.
Okay. They also gave, last one before I want to get to the overall market, they also gave a general retirement, like recommended minimum retirement savings for 20 years worth of retirement. What do you think that number is? What's like the average recommended to have in retirement? If not, that's fine.
1.5?
I was going to say
1.6. They had it at $1.6 million.
Okay.
Robbie's spot on there as well. They estimate like the average person needs for retirement.
Not a dentist though, just so you know.
Yeah. So all added together, like there's all these different things that having pets. Pets was $36,000, just pets over the course of your life. That feels like a big amount. Vacations at $180,000 over the course of your life. That seems maybe a little low to me, actually. Maybe.
Yeah, that does seem low. And also, if that is the discrepancy here, we're saying you're going to spend $800,000 on cars and only $136,000 on vacations.
Yes.
Something's wrong with that.
They have $44,000 for getting married, $9,000 for dying, $1 million for homes, type of thing. So all of this added together, they added up all these numbers, and they just wanted to give you a dollar amount. Like, here's what it would cost for you to have all of these things that are in the American dream over the course of your life. And it was a little under $4.5 million was the total amount that you need to make to support all of these things. I did the math. So if you want to break it down over like a 30-year career, like what income would you need to make to get to 4.5 million? It's about $150,000 a year is kind of what that adds up to. Now it's probably taxes are not anywhere in this equation. So it's probably like you would need to make like $200,000, before taxes to probably get to some of these things you're paying for. Thoughts on that? Does that feel extremely high? Does that feel normal to you?
Yeah, you're saying lifetime earnings of about $4.5 million to achieve the American dream.
To have a house and vacations and cars and kids and all that stuff that they're talking about here, you need about $4.5 million to afford it.
Let's triple that for a dentist, probably, for the dentist American dream. Yeah, the car one is what throws me off, and the discrepancy between cars and vacations.
Yeah.
And what did you say, Jake, for the house? What did they say?
The house lifetime about $1 million.
So you're saying that something's off with this, in my opinion, because you're saying these numbers are saying, not you. The numbers are saying that you would spend about $200,000 more, only $200,000 more over the lifetime of owning a home rather than your cars. Like that throws me off.
I do know the average car payment in America is above $1,000 right now.
What? Toy above $1,000 for a car payment?
That's just like new cars. Yeah. Above $1,000.
Wow. Okay. Well,
so it's getting up there, and I know cars are a thing. I mean, I know that's a big Dave Ramsey deal, but I'm kind of on that train of cars are probably as big as budget killers as anything out there, car payments and things like that.
Yeah.
But the point that they're getting to, there's a little article and some things that follow this data here, but they're essentially saying lifetime salaries for men equal about 3.3 million and women about 2.4 million. So we are like that $150,000 to $200,000 annual salary mark is way below kind of currently, like that. What we're actually making is way below what this would happen. So they're giving, the argument of the American dream is out of reach for a lot of people at these certain costs with cars and houses and things. That's the main point I think they're trying to get across here. Anyway, I just found that was interesting. 4.5 million. That feels about right to me.
Robbie's like, the American dream may be out of reach unless you don't have kids and don't drive a car, and then you're fine.
Yeah.
No, I'm actually, I as Jake was talking, I was crunching the numbers in a different way in my head. We're saying 4.5 million of lifetime earned income. Like that is cost, all the money that you've ever made. And then we're saying you're spending $880K throughout your life on a car. And I just took that ratio and it comes to 19%. So out of all the money you've ever made in your life, 19% of that is going on a car. And if you need 1.6 million to retire, hold on.
That's the point there, is they're including retirement in here. So they're assuming you are saving up 1.6 million for retirement, which I do not think most people are doing here.
And 1.6 million divided by 4.5 million, that's 35%. So 35% of all the money you've ever made is what's left for retirement, right? I don't think there's a right or wrong answer as long as you stay solvent and you don't starve, or, but the idea is like, in terms of our values, 19% on transportation. Do we value transportation that much? Like, compared to other stuff? It's wild.
Yeah, we could do a whole show on this, Rabih. That's a really good point, though. Like this, it's so funny that you can let's assume for a moment all this data is exactly right, and accurate, and that it's scientific.
It's not, but we can assume that.
Yeah, but let's just assume for a moment that it is. The conclusion that you take out of this could be a bunch of different things. So their conclusion, apparently, they're saying, well, this means the American dream is not attainable.
Yes.
What Robbie's alluding to, I also think another conclusion you can come to is like Americans have out of whack values of like what actually is important to them, what they say is important versus what actually is important. And also there's a narrative here of like the expectations of what a good life is and what kind of car do you need to have to be happy. Anyway, there's a lot of different conclusions. That's probably one of my biggest issues with this, Jake, is that if they're coming out of this being like, see, unattainable, can't do it, American dream's over, it's like, well, no, maybe we just have to readjust what we actually think the American dream is.
I think that's a perfect takeaway. I think that's awesome. Yeah, saying, cars are way too expensive. Everything else here seems a bit reasonable. Yeah, but what I also thought about too, as you guys were talking, is that of this 4.5 million, they're allocating 1.5 or 1.6 for retirement funding and savings that you're going to build up there. So if you're not saving a lot, which most people are not, right? The median savings rate in America is 0, right? That's kind of the average is about 3 to 4%. Median is 0. Then you only need about 3 million to fund all these things without saving a penny for retirement. And that's closer to, $90,000, $100,000 a year in income over the course of a 30-year career, which seems pretty
more doable.
I think that seems more doable than what a lot of people are doing. But yes, I think you need to reach higher to save some more. But anyway,
and I was not kidding when I say dentists out there. Obviously, this is a dentist show. Multiply these numbers by 5. Yeah. Like honestly, if you're saying 1 million to 1.5 for the average American to retire, no, a dentist times that by 4 to 5.
This is a very general. Take this with a huge grain of salt. But I think for most dentists, and even a lot of people moving forward, right, if you're in the middle of your career, as we experience 20 more years of inflation and rising costs of things, I mean, $5 million is a pretty very broad general place of what you're going to need to get to retirement savings and funds to live the life you want.
That's what I've always said, Jake. If you're a dentist off the street, you walk up to me, I know nothing about you, and you just say, how much do I need to retire? I'm going to shoot for about 5 million.
Yeah.
On average, just generally. So, Rabih, any final thoughts on this?
Well, I loved it.
Okay. I love this. I love the variety of topics we always hit.
It's fun.
Hopefully everyone gets something out of these shows. If you want to talk to us, if you want to know more, if you want to share your story with us, dentistadvisors.com, click on the yellow button. If you like the show, maybe share it. I don't know. If you like it, share it. If you like it, go rate us, leave a comment. If you want us to talk about certain things on this show, if you want to hear Rabih talk about certain topics, because we all know everyone's here for Rabih. I'm only here for Rabih. So
not true.
Let us know. Leave us comments. Go on our Facebook group. Everyone, thank you so much for listening. Rabih, Jake, thanks for being here. That was our 2 cents. Have a great weekend. Bye-bye.